Hello everyone, welcome back. This is Health Economics. So in chapter 10, we are going to discover the problem that we face in the insurance market. So this problem is what we call the adverse selections. Well, we have talked about this insurance market might have many different issues brought by the asymmetrical informations. So this adverse selection problem, it's basically one of the two major problems that we are going to study in the upcoming two chapters. So to start with this chapter, we are going to go through the asymmetrical information model, and then we will talk about the adverse selections in the health insurance markets. We are going to talk about some of the examples. And then we would like to show some evidence also happens in other insurance markets that related to adverse selections. And at the end of this chapter, we would like to discover what prevents the adverse selections happens in the insurance markets. So the story actually began with something similar to this one here. Let's suppose you're running an insurance company. You sell insurance package to people, and then you collect the premiums. When someone who bought your insurance and they have some kind of health problem, you have to pay for their healthcare costs. And suppose there is a man walking into your office one day of a life insurance company that you run. And this guy actually walked in and asked you, well, you know what? I want to buy a $1 million life insurance policy just for one day. Well, this means your company will have to pay $1 million to this guy if he dies tomorrow or before tomorrow. So within 24 hours, you can actually imagine anything happened to him, well, that caused him to death, well, your company will have to pay for that $1 million. There's nothing you know about this man, of course. The only thing that you might actually can observe is how he looks and how intelligent he is by his way of talking, and also by what he is wearing or what how he looks like. Is it healthy person? Is it a weak person? Right? So all this kind of thing that you can observe by virtually. The problem comes to your side. So how much are you going to charge this man for this $1 million life insurance? Well, obviously, you can charge this man $1 million because, well, to you, obviously, the chance of one person die the next day or maybe within 24 hours might be very, very low. But the thing is, there is no way for you to figure it out. It's almost like you are gambling to bet on this guy it's not going to die next day. And this man obviously have a lot more information that he knows about himself than what you do. That creates an asymmetrical information situation. So let's talk about some of the real examples that we found in the asymmetrical models and some of the predictions that we can come up with. So under the asymmetrical information models, in the past two chapters that we missed in the textbook, well, you can always feel free to go back to the textbook and try to read through those models. But for the purpose of our course, we are not going to go through those details. So because of this asymmetrical information that we described in the previous example, let's suppose, well, there are three main projections that we can make in the insurance markets. Number one, well, that guy walked in, obviously, buying this $1 million life insurance. There might be something that he knows that could possibly happen to him. So obviously, when you find out the risks for covering this person is going to be high, obviously you would like to charge him a little bit more money to counterfeit that risk that you're bearing for this person. So in most insurance market, we know it. the positive correlation between risk and coverage, it's always engaged. So that means the higher the risk, the higher the coverage that person would like to buy, or the higher of the coverage would like to be covered for the risk being encountered. And number two, instead of a bulk discount that you usually get from a supermarket, let's say you're buying 1 can of Coca-Cola versus you're buying a 6-pack of Coca-Cola from your supermarkets, or you will get a bulk discount. You buy more, you get discount more. But in the case of insurance markets, we actually get a projections of bulk markups. Because when that guy actually come into your company and trying to ask to buy this $1 million life insurance for one day, well, obviously he is willing to pay a lot, first of all, right? But the thing is, it doesn't mean that you are bearing less of the risk. Well, because the higher risk you are cover for this person now, you don't know who he is, you don't know what kind of risk you're taking on. Well, the only way that you can actually protect your company is to mark up more in order to counter those risks or potential risks for the insurance. And number three, there's an adverse selection that spirals. If that problem actually keep going on, you're going to charge more for that person, and then that person will actually end up paying higher costs. And at the end of the day, the insurance company charging more, it will eliminate more people buying the insurance, because people, the regular people in the markets, they might think that, you know what, with this high price, we might actually as well quitting the insurance market, because, well, I only have to pay certain amounts of money for my healthcare costs. But then the health insurance company, they are trying to protect themselves by charging higher premium. Well, more and more healthy people will be escaping the insurance markets, and all we have left in the insurance markets are basically those people who will be sick and also has a high risk to cover. So all these three are the main projections that we get from the insurance markets with the asymmetrical informations problem. Well, in chapter 9, of course, we didn't cover that chapter, but then there is one model that predicts what might actually explains the positive correlation between risk and coverage. So in the Rothschild-Stiglitz models, the failed individual will be fully insured, but pay a high premium per unit of coverage. And the robust individual will be partially insured, but pay a lower premium appropriate to the health risk. So those are the evidence that we could find in today's markets. Obviously, people who are being sick already, they would like to have more coverage so that they don't have to pay more out-of-pocket costs when they visit the hospital. On the reverse, the robust individual, the healthy individuals, obviously, they don't want to pay a very, very high premium to have a full coverage. Instead, because they know that they have very low risk to get sick or maybe get into the troubles for the healthcare services, they would like to actually pay a lower premium, because they know it. Those money they pay, it's not going to be in use because they won't get sick very soon. So this basically explains why in the health insurance market, we always see this positive correlation between risk and coverage. The bulk discount, again, the lower per unit cost for the large purchase of commodities. It's what we described in the case of buying 6-pack of Coca-Cola instead of 1 can of Coca-Cola in the supermarket store. However, in the insurance market, we usually see a bulk markup, a higher per unit price for a larger purchases of the commodity. Well, this bulk markup basically is a tool that helps the insurance company to protect themselves from a risky customers who wants to buy a lot of the insurance. So this is exactly what Rothschild-Stiglitz models predict. So in the real life insurance market, the insurance company, they usually will pool between different risk types together. So in this types of markets, obviously, the problem of adverse selections is going to lead to a very, very serious problem known as the adverse selection death spiral. So this spiral actually starts with the story as the following. Let's suppose we have 8 individuals living in a small town, and I list out all the healthcare costs for every single individual, depends on their health conditions. So on the left hand side, you will see the very, very extremely healthy person that pays $0 on the healthcare costs, versus the person on the right hand side, which he has to pay $700 for whatever that he is having problem with his life. So let's suppose there is a insurance company. It's providing this standard universal coverage for every single one in the market, and this insurance company is going to charge this universal price or premium at $400. The high quality bodies in this market, which means the healthier, robust individuals, obviously they will be go against paying this premium of $400, because obviously they know it. By paying this $400, well, they will not have to spend as much as they would needed to. So the high quality bodies obviously will leave the insurance markets when the universal premium is set in the markets, and it only left with the sick customer. So both the frail and robust individuals, they are pooled together in this market, and the premium average cost of the people in the pool, it's being set to the markets. Well, it leads to the frail types basically are indirectly subsidized by the robust ones, and obviously the robust types exits the pool, leaving only the unhealthy individuals in the markets. So that means the 4 individuals on the right hand side here will only be buying or involving in this insurance markets, whereas the left hand side 4 individuals, they will leave the markets. However, the thing is, by having the money collect from all these 4 individuals on the right hand side, the insurance company will still have to pay $700 for the farthest right hand side individuals, $600 for the second one, and then $500 for the third one, and $400 for the fourth ones. That means on average the healthcare costs for each customers will be $550, but only $400 is being collected by every single individuals in the markets by the insurer. So in this case, obviously, well, the insurance company will lose money. Well, the insurance company, they are a profit maximizing firm. Obviously, they won't just sit here and say, well, you know what, we are going to just lose money every single month. Well, this will get into a cycle. So this cycle will repeat itself. Let's suppose the insurance company figure out the total average cost is $550 for every single individual they have to pay in the markets. So they adjust the premium now to $550. Again, well, more healthy individual will leave the market again, and that remains to the pool of customers gets smaller and also sicker. In this case, obviously, only people who will be buying this $550 premium coverage will be the last 2 individuals on the right hand side, which they have the healthcare cost on average of $600 and $700, where the people on the right left hand side, they will all leave the market because they know it. By paying out of pockets, they don't even have to pay that much of the premiums comparing to the coverage. So the average healthcare cost for each customer will be now go up to $650, but only $550 is being collected by the insurers. And obviously, again, well, it will get into a cycle again. The insurance company will keep adjusting the costs according to what is being paid to the insurance individuals. And this will never end it until finally only the sick people left in the market, and the insurance company will never have enough to pay for that last individuals for the healthcare costs. So this death spiral actually happens a lot in the health insurance market, but not only just the health insurance, but obviously there will be a lot of other insurance markets that we will talk about later also involved with this death spiral phenomenons. So let's, after talking about the three projections or the three predictions of the adverse selections models, well, let's talk about some real cases that we found in the real world. So before we talk about the evidence that we found for this adverse selection problems, we would like to define quickly about these two types of problem we are studying in this two chapters. So first of all, adverse selections actually describe the customer behavior at the time when they buying the insurance coverage. So usually it comes from the fact that consumers of insurance, they are trying to hide some of the information, or maybe taking advantage of this asymmetrical information from the sellers of the insurance coverage. On the other hand, the moral hazard problem actually coming from the customer's behavior change after buying the insurance coverage. So the classic example of moral hazards is basically consider yourself before you buying the auto insurance for your new car. When you're driving your car on the road on the way to the insurance company to get that insurance, well, you'll be very, very careful on the road, because the fact is, well, you know, anything happens, you have to pay out of your pockets because nothing is being covered yet. After you visit the insurance office, obviously, you know that your car or yourself, it's being covered by the auto insurance. Now you will be a little bit more risk-taking, or maybe a little bit more reckless on the road, because you know anything happens, it will actually cover by the insurance. So this is basically a problem of moral hazards. So after buying the insurance, well, customers' behaviors actually change to be a little bit higher risk taking natures. The issues that we usually encounter as an economist is to identify the risk before the insurance, or the risk before buying the insurance, and the risk after buying the insurance. We have a term for it. Before buying the insurance, it's what we call the ex-ante risk, and after buying the insurance, it's the exposed risk. Well, these two types of risks actually help us to explain where the individual actually somehow change the rate or the risks that involve with all these different healthcare services that might comes into their life. So these two terms also it's being studied in many of the financial economic studies. So you can actually think about risk. It's not only risk involved with accidents, or maybe risk involved with getting sick, or maybe getting cancers. Well, risk can also be defined in many different terms, especially in monetary term, when people are actually investing money. There's a risk for losing money, right, or gaining money. So risk can also be defined in many different aspects in different studies. But in our course, of course, we want to focus this risk as the risk for getting hurt, or maybe getting involved with any health care needed in life. So again, well, even though defining these risks are very difficult, and most of the time economists can only capture the exposed risk, because, well, there's no way that we can actually ask any individuals before they're buying the insurance how risky they are with their behaviors. Most of the risks that we study are exposed risks. But either one way or the other, the thing is, the problem of adverse selections and also moral hazard actually help explain the exposed risk will always be greater than ex ante risk. One way or the other, you can actually think about when the insurance company asking that person, you know what, have you ever been into any kind of cancer? If that person trying to hide this information, obviously the company will think that the ex-ante risk was very, very low. But after this individual buying the cancer insurance, well, the exposed risk become very, very big because it's not that person changing the behavior, but just because the fact that he was hiding those information himself. And on the other hand, moral hazard also explains the same situation, but in just different ways. Before we get the auto insurance, the ex-ante risk was low, but then well, after getting the auto insurance, we know the car it's being covered, so the exposed risk will actually increase. But one way or the other, it's still basically how we actually explained the problems that we face in the insurance markets. All right, so let's talk about some evidence that we found for adverse selections in the health insurance markets. So some of the data that we use to illustrate in the textbook is by Rand HIE. This is the data that we study in chapter 2. Hopefully you kind of remember. So some of this data actually spit out the problem of adverse selections. First of all, well, we found in this data, individuals are able to predict the healthcare costs for the year to a good degree of accuracy. So obviously, people know exactly how much they will get involved with the healthcare costs and what's the conditions of their own. And specifically, they are able to predict the healthcare costs more accurately than the insurance companies. And in the data, also the families with high predicted costs will more likely to want supplemental insurance. So that means, well, people who knows that they will have to pay a lot of healthcare costs, well, they want to buy more of the insurance so that they are being covered. So this suggests the risk and coverage correlation as being positive, just like how we predicted at the beginning of this chapter. So higher risk, well, higher coverage will be barred. And we are not only just getting an average number of how people buy insurance. Indeed, this correlation is being explained in many different markets. So there are several studies has been done, which also showing that first of the three predictions is being confirmed in many different health insurance markets. One specific markets that we would like to actually talk about, or the book has illustrated, is the Harvard professor's case that's studied by Cutler and Sectors in 19. So in the Harvard University study, there are about 10,000 people it's being in the study between the year of 1994 to 1997. So the basic background of this study is coming from the fact that Harvard University employed about 10,000 people full-time in 1994. As part of the employee benefits, all of them get access to a low-cost, low-benefit HMO plans, as well as the high-cost PPO plan from Blue Cross Blue Shield. So the plan premiums and the enrollment has been relatively stable for many years. Until 1994, about 18% of the employee is being elected to pay more for the PPO plan. In the same year, well, what happened is there is a budget cut at university. The administrator now they actually needs to reduce the the employer subsidies for the PPO plan for the 1995 fiscal year. So the PPO plans will be much more expensive to get for those employees working at Harvard University. The difference between the PPO plan and the HOM plan, the HMO plan in 1994 was about $361 difference. However, in the fiscal year of 1995, it will jump up to $731 difference between the two plans. The fact is, we would expect a lot of people might actually quit the PPO plan because it's so expensive to buy. But the fact is, well, it's turned out only 4% enrollment has been dropped in the year of 1995 after the change of the premium price. So that means, well, a lot of the people still staying in the PPO plan. Well, originally they are already getting the PPO plan and they don't mind to pay almost double as much of the difference of the PPO plan comparing to the HMO plan. Well, that's what happened in 1995, and it kind of gave us a sign understanding, well, the people who were originally buying the PPO plans, obviously they are the people who prefer to get this high premium coverage for their health insurance. And usually those people are basically at a higher age comparing to people who switch to the HMO plan. So that actually kind of like an evidence. Well, on the other hand, in the next year, the premium actually for the PPO plan rise again because of the budget cut. So now the difference between the PPO plan and the HMO plan in 1995, it's $1,414. So the PPO stayer in 1996 were again much older than the PPO leaver. So people who stay in the PPO plan, about 9% of enrollments, they are basically the people who actually needs those high coverage, comparing to people who leave PPO plan. They will switch to the HOM plans. Those people are basically younger and they know they don't need that much coverage for the health. So this is basically an evidence of adverse selection, but not only just that, this is a very clear evidence of the adverse selection that spiraled, because you can actually see the PPO plan only left with all these sick people, very, very high age populations, where the insurance company will have to pay a lot to cover them, but leaving a lot of the healthy younger populations out of the PPO market. Well, of course, not every study actually found consistent evidence for the positive risk coverage correlations in the health insurance markets. Well, one of the specific examples, it's done by Carden and Hendel in 2001. This study actually focused on the data sets of U.S. worker and their employer-sponsored health insurance options. So at the beginning stage of this study, they still do find the health care costs and coverage are positively correlated. However, this correlation actually disappears when costs are adjusted for factors like age, race, and gender. So basically, this implies when the employee cannot hide this observable factors like the age, the race, and the gender, and then some very simple medical backgrounds to the insurer. Without taking the information advantage, well, the adverse selections will die down or will die out. On the other hand, we have another study which is done by Fang et al. In 2008. This study actually it's related to the health insurance markets that actually exhibits the negative correlation between risk and coverage. So among the Medicare beneficiaries in the United States, it is the healthier beneficiaries rather than the sicker ones who disproportionately choose to purchase the supplemental insurance policy known as the Medigap. Well, seniors who choose to purchase the Medigap incurred about $4,000 less in annual medical expenses on average. So that means people who buying more of the supplemental insurance, they actually spend less money on medical expenses. So this actually is a negative relationship. So the study actually argues that this advantageous selections occur because the seniors with greater cognitive abilities are both healthier and more likely to purchase those Medigap. So in this case, obviously, the two reality evidence suggesting not every time we will find the positive risk coverage correlations that basically identifies the adverse selections in the health insurance markets. Sometimes we may actually have even the negative ones or maybe none. But what characteristic that causing those adverse selections to die down is what we would like to talk about later in the sections. So adverse selections in other markets are also common to find. So in this section, we would like to actually take a look at some of them. So let's quickly go over some evidence about adverse selections in other types of insurance markets. So in the automobile insurance, there are many studies has been done. There is one specific example that in the books illustrate the positive risk coverage correlations in Israel. However, not every country will observe the same results. The study done by Chiapuri and Saleni in 2000s about the rookie French driver with 1 to 3 years of driving experience, we actually found no correlations between risk and coverage. But this actually being explained by the paper itself because the fact is the young drivers, not only they are inexperienced driving on the road, but also at the same time they are inexperienced dealing with the insurance company. So they are basically not having the experience to take advantage of their information to practice the adverse selections in the markets. So for example, young drivers who might got into accidents during the driving trainings, they might actually very honestly to without that accident to the health insurance company, so that they have to charge this persons a much higher premium comparing to other young driver to counter the risk. So basically there are some informations that they could hide to get a lower premium price of the insurance, but because it's the first time they're buying the insurance and they're reviewing all the questions that it's being asked by the insurance company, so that's why they couldn't take advantage of the adverse selections. So that's the reason, or maybe that's the one explanation to actually help explain why there is no correlation is being found between risk and coverage in France. Life insurance is another insurance market that has this adverse selections studies done in the past years. Well, one specific predictions of adverse selection models in the life insurance market is that if customers know their mortality risk better than the insurer do, the life insurance market should always be dominated by the sickly, not the well. However, contrarily to these predictions, Carley and Philipson in 1999 actually studied the mortality data in US, found the life insurance holder tend to live longer. And there are other studies done in the UK and Japan also suggest the same results. Well, this actually, again, can be explained by the methods of those studies it's being done. Some of this study only track people between certain time periods after they bought the life insurance. Specifically, it's maybe starting the second year after they buying the life insurance, or 5 years, or third year, or 7 years, or maybe within certain periods from 2 years to 7 years after buying the life insurance. However, some of this study actually overlooked the policyholder who die in the first year, which is the time period 1. And this overlooked or misjudged mortality risk, it's being contributed to this study, and failed to find this positive risk coverage correlations, where it's usually sick people will buy the life insurance instead of the wells. Also, there is another study about the insurance market for teachers, which indicates the insurance company, they are willing to offer a bulk discount, which we talked about earlier in the chapter. It's rarely the insurance company will offer a bulk discount. But this is an indication of how well the insurance company or the life insurance company, they can actually predict or maybe models the life expectancies of individuals, teachers, or the customers. And also being suggests that the asymmetrical information is not being contribute to any of the life insurance markets, because the company are so well to predict how long the individual can live. Vehicle settlements basically is an other types of life insurance contract, but in this case, when the firm purchase a life insurance contract from a sick people and then collects the payouts when this person die. So there are many people actually bought the life insurance themselves, but later in their life they found out they have this sickness that they cannot treat, like the HIV patients. So many of the HIV patients, they actually bought the life insurance, and they know it, they don't have the time, or maybe they don't have enough technologies to heal themselves, right, with the treatments that's available. Well, in this case, obviously, those people would rather get the money now and enjoy life, spend the rest of the time with good quality, instead of spending the rest of the time having the life in the hospital. Or sometimes people just don't have the money to pay for those treatments, or maybe staying in the hospital. So they would rather to get those money in advance in order to before they die. So they would actually sell those life insurance contract to those vehicle settlements company. So this become a market. But the thing is, in this market, obviously, the HIV patient, they will gain the liquidities of money that they need to pay for the treatments, or maybe other things in life, where the vehicle firms, they depend on how much it pays for the policy and how long the original policy holders end up living, might stand to make a profit on the transactions. So the longer the patient survive, the faster the company will retrieve those payments from the insurance company. So in these types of markets, obviously adverse selections might appear if the HIV patient is trying to hide how long they could live. If you think about it, for the vehicle company to buy the insurance contract from this sick HIV persons, they want this person to die faster so that they can get the payments sooner from the insurance company. But the HIV patients know how long they can leave better than the company who buying the contract. Obviously, they could actually tell the contract company, well, I might actually die in, let's say, 5 years. If the company believe in this person, they will actually pay a price for it. However, if that person live longer than 5 years, obviously, the vertical company might actually start losing the profits that can possibly earn from buying this contract. Well, there are so many factors been coming into this market that affects how well the vertical firms measures the life expectancies of the HIV patients, such as new drugs, new treatments, and different types of developments of this new technology helps extend the living of the HIV patients. So that's why in the earlier 2000s, we actually seen less and less of these vertical companies available to buy those insurance contracts from the HIV patients or maybe other cancer patients. I think the questions to answer in this chapter is how to actually prevent or maybe even just eliminate adverse selections in the health insurance markets. Obviously, we cannot let this market running itself by assuming the insurance company they will always lose money because they are being taken to this disadvantage selling the insurance coverage to those people who are hiding the informations. So after looking at the evidence of adverse selections in different insurance markets, and also I would suggest you to read the textbooks, there are 4 main reasons that actually help to explain why would adverse selection not occurred in a insurance market. Number 1, when customer they misperceived their own risks. So for example, if there is one customer think that he might has 50% of a chance to get cancer next year, but in fact his risk is only 5%. Right? So this misperceptions can actually cause this customer not be able to take advantage of adverse selections. And number 2, customers do not act on the private information. So in some cases, even though customer they have this private information on their own, but they do not actually take advantage in the insurance markets, such as we talk about in the automobile insurance markets, where the rookie French drivers, they're not only rookies on the road, but they're also rookie to buying the insurance, so that they do not know that they can take advantage of these informations. And number 3, insurers can accurately observe customers' risk. So in the modern day, there are many different things that the insurer can do in order to accurately observe or maybe estimate the risks the customers involved with the health insurance coverage or maybe buying the insurance. So those very, very high level of mathematical models can actually help insurer to eliminate the adverse selection problems that they faced in the markets. And lastly, it's because of the advantageous selections, which we talk about in the case of the Medicaid, Medicare markets, where people, the seniors in the US, they would tend to buy more of the supplemental insurance, but which they only spend less on the medical bills comparing to other who do not buy those supplementals insurance. It's a choice of how risk averse the individual is in the markets, basically. Generally speaking, not everyone can accurately estimate the risk in life. So for example, there are some study has suggests these conclusions here. Surveys that actually involve with Americans and Swedish students. The question asks those students how safe they are comparing to the medium drivers on the road. 88% of the US students actually believe they are safer than the medium drivers on the roads, comparing to 77% of the Swedish students believe they are safer than the medium driver. Well, this is indications of how inaccurate people sometimes can estimate the risk comparing to other situations. Also, there are evidence suggesting how people can actually misperceived risks occur in health. So according to a survey of elderly in the US, so male respondents aged 85 to 89 report a subjective probability of reaching age 100 of 31%. Even though the objective life table showed that only about 3.4% were actually willed. The younger females were more pessimistic about their life expectancy. Only 51% of the female age from 70 to 74 thought they would reach 85 years old, even though the life table reports 57% of a survival rate. So in this case, obviously, both the male and females, they have inaccurate estimations of the life expectancy on their own. The male, in this case, it's basically over-optimistic about the life expectancies going to age of 100, comparing to the females, as in this surveys, well, they are basically too pessimistic about the expectation life goes to 75 or 85 in this case. So mortality table actually tell us about the facts of how far people can live and how inaccurate the people are actually expecting or perceive expectations of their life expectancies. So by this evidence, obviously, not every time we can actually take advantage of this personal information to start the adverse selections in the insurance markets. Well, another types of factor that actually is not letting adverse selections to occur is when the customer not taking actions with the private informations. So the real customers have more important things to think about rather than the small bargains on insurance. So if you think about when you're buying a health insurance that costs you, let's say, $1,200 a year. Well, every single month, basically, it's about $100 you have to pay, and you divide it up into every day, it's about $3.30. So sometimes people might actually think about this insurance plans or coverage, and they don't even bother to pay maybe $1 or $2 more bucks every day, or maybe even a few $100 more bucks a year, in order to save time and not actually fighting for a small cut on those premium. So customer may fail to realize the advantage because of this time consumptions on bargainings. Especially, the car owner can predict how many miles they will drive in the coming year with good accuracy, and sometimes yet they do not seem to take that into account when deciding how much insurance to purchase. Well, not only the customers, they are not taking the advantage of this adverse selection. Sometimes the insurer can actually eliminate on their own. So when insurer can accurately observe the customer risk, Well, obviously, they can try to charge the correct premiums on the individuals. For example, the long-term care insurer with access to historical data and teams of analysis, they are basically grouping to formulate those risk factors of an individual in order to predict how much of a nursing home care that it's being needed, how much of a hospital care, how much of a medical care that it's being needed for the customer themselves. Well, in the pre-HAART days, well, the vehicle settlements firms could accurately predict the HIV life expectancy from the simple blood tests. Remember, in the vehicle settlement firms, they would buy insurance contract from the HIV patients. Before things are getting complicated, well, those firms can simply just ask the patient to take a blood test, and after getting the results, they can most likely getting a very accurate time of how long the patient can live with the insurance contract they're buying. So remember that all of our model rests on the assumptions of information's asymmetries. This asymmetry actually being created by the buyers of the insurance package. So if those advantage is being eliminated, right, when the insurer can accurately observe those risks from the customer, obviously we can no longer take advantage to get those low price premiums to take advantage of the insurance company. Well, of course, when buying the health insurance or any kind of insurance, risk is the major factor to decide how much of an insurance an individual customer would like to buy. But sometimes risk is not the only factor. There are maybe other factors for someone who decided to buy insurance, such as maybe income, maybe superstitions, or maybe other things in life that move the demands of insurance. If privately observed health risks are the dominant consideration, then selections into insurance will be averse from the perspective of the insurer. If other considerations like risk aversions offset this particular selection mechanisms, well, then the selections is no longer averse. It might even be advantageous selections if the healthier people are the ones who disproportionately purchase the insurance. But why? For example, it could be the fact that that person is more risk averse, right? So this risk averse drive this person crazy, even at a very, very high premium. Will still want to purchase it just to make sure life will be offset by, or maybe being taking all this uncertainty out with this high in premium price. Or maybe that person who purchasing the insurance, they just have a higher income comparing to other people. Or it could be the person has a better understanding to take advantage of the insurance benefits. And what other? Well, we also have an example showing how people are taking these advantageous selections. So remember in France and all 2008, we talked about the elderly people who were buying the insurance, supplemental insurance, even though they have the Medicare coverage by the government. This shows a negative correlation between risk and coverages. So this may be because the smarter customer better understanding the benefits of the insurance, or maybe they can find better deals on the markets comparing to the Medicare. However, this creations of the negative correlation between insurance coverage and risk, it's rarely to see. Well, there are other examples that have been talked about in the book. They're all basically explaining how the individual customers in the insurance market taking the advantages selections. They are basically choose to get more insurance than they needed because of other factors, like what we have talked about, like maybe this person is more risk averse, or maybe they have higher level of income, or maybe they just know it, the insurance benefits worth the price they're paying. But all of this actually explains how the adverse selections might not occur in the insurance markets. So in this chapters, in general, we actually assume most of the theoretical examples has the assumptions of heterogeneous risk type, but a homogeneous risk preference. So that means they might face different types of risks in their life. Some people might have a higher chance to get cancer versus some people might have a lower chance to break their ankles in their daily life. But the preference will be the same. So that means they are equally risk averse. That's what we assume. However, in the reality, we actually cannot make such assumption, because it could be the case both the risk types and risk preference to be heterogeneous, to be different. Sometimes it could be both are the same. Sometimes it could be one is homogeneous, the other is heterogeneous. Let's suppose if we assume a homogeneous risk type, that means, well, everyone will face the same risk for having cancer within certain years, and a heterogeneous risk preference. So that means people are different in the preference for risk. So some are more risk averse, some are more risk taking. Well, in this case, well, a general solutions to this assumption is a negative correlation between risk and insurance coverage will be formed. Instead of bulk markups, well, usually bulk discount will exist in order to encourage people to buy more insurance in the markets. And also note that spiral with insurance pooling will exist. People who are more risk averse, obviously they will stay in the pool to buy insurance because they prefer to have a more security in their life. Well, so it really nails down to how the market structures actually is. And indeed, in more reality that we face, usually the people in the pool or in the markets, they are both heterogeneous risk types and heterogeneous risk preference. The conclusion we can draw from these chapters are filled. Number one, according to the previous two missing chapters, the models actually has some specific predictions about the insurance markets and how it will look like. Well, because of the asymmetrical informations, it creates adverse selections in the health insurance markets, or in general, insurance markets. There are evidence found and confirmed these predictions in some markets. Well, not for all. Some insurance market actually found the evidence that go against the adverse selections. Well, which is not disappointing, because, well, this actually helped us to explain what might actually resolve the problem of adverse selections in certain insurance markets. So adverse selection is very crucial to understand, because it's actually the main challenges of most of the health policy in different parts of the world. Especially in the United States, the major goal of social policy is to encourage pooling between different people of high health risk and the people of low risk together, and to join this health insurance markets, so that we can actually diversify the responsibility or the healthcare coverage from the lower risk group to a higher risk people in the markets. Well, The adverse selection is a very interesting topic. I strongly suggest everyone to read through the books and go through the chapter once by yourself. And I will continue on the topics of moral hazards in the next chapters. So I'll see you next time.